Hello, welcome back to class, and this is Cost and Management Accounting. And today we'll be discussing on marginal costing and break-even analysis. Marginal costing and break-even analysis, and we will look into the key concept of marginal costing. We will also look at the concept of contribution margin. We will look at cost volume profit analysis, the break-even point analysis, and also we apply marginal costing and the cost volume profit analysis to managerial role. If we will have to talk about marginal costing, let us imagine this. Maybe you have a factory and you pay a rent of 100,000 naira every month. And whether you produce one item or you produce 10,000 items, the rent is actually fixed, and that's the fixed cost. And now imagine for every item you produce, you used 50 naira of material. This is a variable cost, and it varies with the number of items. Now, having that understanding, what is marginal cost? It is the technique that clearly separates these two types of cost that we are talking about, the fixed cost and the variable cost. And its main goal is to focus on what happens when we produce one or more units. And this is what we call the margin. What happens when we produce one or more units? It is the margin. And why do we do this? This is done because for many short-term decisions like a special discount order, fixed costs like rent are already paid and are often irrelevant to the decision. We only care about the cost that changes. And looking at the fixed cost and variable cost more, the fixed costs are the costs that do not change with the level of production or sales, and they are like a flat rate monthly subscription. Example are the rents, manager's salary, annual insurance, depreciation of machinery, and in marginal costing, these are treated as period costs. And this means that the total fixed cost for the period is deducted from the total contribution to find the profit. And for the variable costs, these are costs that changes directly and proportionally with the level of production, and they are like the pay as you go data. And example are the direct material, the direct labor, if paid per unit, the packaging, the sales commission. These are the examples of variable cost. And in marginal costing, these are the product costs and are used to value inventory. And you see the difference between the fixed cost and the variable cost. One is fixed and one varies as production process happens. And now we talk about having an understanding of the key concept of marginal cost. Yes, the marginal cost is the additional or incremental cost incurred in producing one more unit of output, and it is the amount at any given volume of output by which aggregate costs are changed if the volume of output is increased or decreased by 1 unit. And in practice, the marginal cost comprises of the total variable cost per unit, which are the direct material, the direct labor, the direct expenses, and the variable overhead. And mathematically, as per the formula, the marginal cost can be calculated as direct material plus direct labor plus direct expenses plus variable overhead. Understanding marginal cost is vital because it serves as a benchmark for determining the minimum acceptable price for a product in short-term decision-making scenario. Now, let's move to contribution, another key concept. What is contribution? It is actually the amount of money from sales that is left over after covering all variable costs, and this money contributes towards paying for fixed costs, and once they are covered, towards profit. And the formula is contribution is equal to sales revenue minus total variable cost. We can calculate it also as it's in per unit, as contribution per unit is equal to selling price minus variable cost per unit. And why is contribution so important? It is important because it helps to be able to understand how profitable a product really is. It also helps to be able to know the fundamental concept behind break-even analysis, and it tells us if a special order is worth accepting. That is, if it generates positive contribution, it's usually good. Then we move to the next point, the next thing to understand concepts about marginal costing, and we talk about the cost volume profit analysis. What does this mean? It's actually a model that helps us to understand the relationship between a company's cost, whether fixed or variable, the volume of the item it sells, and also the profit it makes. And you see that it's actually what the meaning words that are formed together. It talks about the relationship between the company's cost, the volume of items to sell, and the profit it makes. And it answers critical business questions like how many cups of coffee do I need to sell to cover all my costs, and that is break even. And if I want to make a profit of 1 million, how many units must I sell? And what will happen to my profit if I increase any selling price by 10%? And the fundamental profit equation is actually profit is equal to selling price minus variable cost multiplied by units sold minus fixed cost. And it is also the same as profit is equal to open bracket contribution per unit times units sold close bracket minus fixed cost. Now, when we talk about we will talk about the break-even analysis. When we talk about the break-even analysis or the break-even point, it's actually the exact point total revenue equals total cost, and as you can see in the diagram showing, it is the point whereby the total revenue and the total cost equals each other. And at this point, the business makes no profit or no loss, and it is the minimum sales target to avoid losing money. And how to calculate this? It's actually total fixed cost divided by contribution per unit, and this tells you how many units worth of contribution and be able to cover the fixed cost. And in terms of sales, the break-even point is actually total fixed cost divided by the PV ratio, the PV. And when we look at the metrics, what are the essential metrics of cost, volume, profit? And we have the PV ratio and the margin of safety. And when we talk about the PV ratio, it actually shows how much profitable it gets from each naira of sales. And you see this formula there. And this is if you sell a product for 100 naira, contribution is 40 naira. Your PV is 40%. The PV ratio is 40%, and that is 40 divided by 100, 40 divided by 100 multiplied by 100, and that gives you 40%. And this means for every 1 naira of sales, you have 4 kobo to 40 kobo to cover fixed cost and profit. And a higher PV ratio is better. And talking about margin of safety, it is this is your safety cushion, and it shows how much you can fall before you start making a loss. And you have the formula there as it has been stated. And a high margin of safety means lower risk, and a low means you are close to being unprofitable. How managers use these tools in real life, that's the application aspect of it that said we'll be talking about. And for this, we talk about pricing. For this, it helps when questions like a customer wants a one-time order price, should I accept? Yes, the answer will be that if the special price is greater than the variable cost, yes, it will increase total profit. And also in terms of make or buy decision, the question like, should I make a component myself or buy it from the supplier? The answer would be that you compare the variable cost of making it internally to the supplier's price. If the variable cost is lower, then it's better to make it as such. And in terms of choosing best product also, questions are there. And in terms of planning for profit, and these are areas which actually helps managers. They use it as a tool in real time to actually make decisions. In conclusion, marginal costing separates cost into variable. The key metrics is contribution, and then the CVP explore the links between cost, volume, and profits. We also see that the break-even point is where total revenue equals total cost, and the PV ratio measures profit efficiency from sales. The margin of safety measures risk, and these are powerful tools for pricing, decision, and profit planning.